In nearly 8 years of being full-time in the markets, I've wasted a ton of time, all because I wasn't focused on what truly moves the needle. If you're just starting out, this video could be the most valuable thing you watch, as I'll be showing you exactly where and when to focus your energy so you can fast track your success and be as efficient as possible in your pursuit as a trader. It's going to save you a ton of effort, energy, and frustration. I only wish I had this resource when I started myself. Number 1, immerse yourself. As a fresh participant in the game, you need to soak up as much information as possible. Let your curious mind loose. This is the stage at which this is most appropriate. Later on in the journey, you'll be encouraged to do quite the opposite, but for now, you need to spend as much time educating yourself and exploring as possible. There's a ton of content available to aspiring traders these days, from books to video content and podcasts, and trading courses if you're willing to spend a bit extra. My best advice here, though, is to be as thrifty as possible and keep your wits about you. Many so-called trader gurus are in fact charlatans, waiting to prey on enthusiastic market entrants such as yourself. So do your research and have a sense of street smarts as you embark on this new journey. This is something I wish I'd known earlier, but had to learn the hard way. And it's also why I put together my own free trading course so people like yourself can learn everything you need to know about the charts at no cost at all. I'll link a video at the end to the first lesson in the series. Wherever you choose to learn, when in this phase, start with the very basics of price action, such as candlestick formations, support and resistance, and market structure. And then, once you feel you have a grasp of these, move on to understanding the mechanics of trading, such as order types, stop losses, and risk management. From here, you can branch out into more exciting styles of trading and see which roads you end up walking down. But whatever you do, don't run before you can walk. This journey rewards patience over haste, and you need to build your career on solid foundations. Number 2, style. Trading is a game with many different styles. You may be familiar with the expression different strokes for different folks, and much like an aspiring artist or musician, you need to decide which style you'll move forward with. This, of course, requires a body of research and some substantial time behind the endeavor, seeking out different traders' approaches to the markets, the tools they use, how they execute their trades, which schools of thought they abide by, which indicators they use to support their trades, and the list goes on. This may seem like a daunting task, but the truth is that trading is a very difficult craft to master, and to do so, you have to be relentlessly obsessed with it. If you're truly fascinated by the art, then curiosity will come naturally to you. If you feel you're forcing your time and effort and finding the process laborious, the harsh truth is this game is probably not for you. You may be able to force this time without passion at the beginning of your journey, but in years to come, that natural misalignment will take its toll. You may have heard the statistic 99% of those that try to trade fail. Well, I can guarantee you that the 1% are driven by obsession. Number 3, stance. Once you've willingly let yourself fall down a number of rabbit holes, let your curious mind run free, and explored a vast number of trading styles, it's time for you to settle on your stance. So what do I mean by stance? Well, to put it simply, this is the intended frequency you wish to operate within going forward, and can be broken down into 4 categories: scalp, intraday, swing, and position. Scalp traders, or scalpers as they are commonly known, make very short-term trades, often holding positions for seconds or minutes, aiming to capture small price movements. Intraday traders hold positions for a few minutes to several hours, but always close out by the end of the trading day. Swing traders hold trades for a few days to a few weeks, capitalizing on medium-term price trends. And position traders hold trades for weeks or months, focusing on longer-term trends and bigger market movements. In determining which stance you're best suited to, I'd ask yourself these 8 questions, writing your answer out on paper to review at the end and use to form your decision. Number 1, how much time can I realistically dedicate to trading each day? Number 2, do I want trading to be my full-time focus, or is this something I want to do alongside other activities? Number 3, do I prefer to spend my time actively monitoring the markets, or do I want to check in periodically? Number 4, do I have the emotional control to handle the fast-paced decision-making required for short-term trading, or would I feel more comfortable watching a position slowly unfold? Number 5, am I willing to hold positions overnight, over the weekend, or for long periods of time? Number 6, am I a patient person who can wait for setups to develop over several days or weeks, or do I thrive on quick results and action? Number 7, how well do I handle stress, especially in a fast-moving market environment? Number 8, do I live in a time zone that aligns well with active market hours for the asset classes I'm interested in trading? People say that price action is fractal. What this means is that you could see a technical setup such as a divergence on the weekly time frame, and you could also see a divergence on the 1-minute time frame. The message being that whatever your style, you can apply it to any time frame. But what they tend to miss out on is that the more higher time frame you go, the more validity that setup has and the more likely it is to play out. I'm not suggesting that everyone conducting this exercise choose position trading as their stance, as the setups are incredibly infrequent, but perhaps instead consider a happy medium such as intraday or swing. Number 4, back and forward test. Now that you have your style and stance decided, it's time to start testing. Take your newfound knowledge to the charts and start applying yourself, but do so without capital. This is a very important message, and you'll learn later down the line that discipline is one of, if not the most important attributes you need in the markets. I'm sure you're itching to apply capital to your trading account, but know this, trading is a zero-sum game, meaning you're either a winner or you're a loser. The reason the industry continues to operate is by means of this relationship continuing to exist. There's a saying that the market transfers wealth from the less experienced to the experienced, and by putting your capital on the line at this very early stage, you're doing nothing more than handing it over to someone that's more than willing to take it. Instead, start backtesting using the replay tool on TradingView, going back as far as possible. If you're backtesting Bitcoin, for instance, you'll want to look at Bitcoin on an exchange with very old data. The go-to is usually Bitstamp, which dates back to 2011. Spend days, weeks, and even months going through historic price action, seeing where you would have taken trades, how they would have played out, and document all of this as you go along in a backtesting journal with screenshots and notes, being as fastidious as possible. Remember, there is no substitute for screen time. Whilst doing this, forward test too, meaning observe the markets as they play out and take test trades in real time, operating as if you're actually putting capital down and getting a feel for the live market as best you can. It may be even more imperative with forward testing to journal your experience. Good traders are built off a simple recipe: journaling, reflecting, and integrating. Do not underestimate the power of journaling and skip this process. It will be what shapes you as a trader, and you should be focusing on it as much as possible. So we're halfway through. If you feel like you're getting more structure and want to keep learning, make sure to like and subscribe. There'll be a ton of content on this channel to help you. Number 5, create an A-star book. Now that you have good experience with your style, the frequency of your stance, and a wealth of irreplaceable experience on the charts, you're progressing well on your path. At this point, you should know exactly what you want to see in the markets in order to take a position, how many layers of confluence you need to execute, and in what environments. From here, you need to make yourself an A-star book. This is a book where you document 10 to 20 of the best trades you can find relevant to your stance. For instance, if you're a scalper, this may be the best 10 to 20 setups that presented themselves over the last couple of weeks. But if a swing trader, the best setups that presented themselves over the last year or so. This is mainly a visual reference, a guide you can refer to before taking your positions. I'd advise screenshotting and printing out the book in physical paper to have at your desk, or if you can, sticking these screenshots on the wall above or next to your trading desk. Just remember, The best traders focus only on the best setups. This gives them the confidence to take positions with size, founded on a robust and stress-tested base of statistics with a high rate of success. I often tell students, instead of taking 5 trades with X risk per trade, try taking 1 trade with 5x risk. Wait for the moment where all the stars align and you have great confidence in the playout. This is where discipline comes heavily into play and separates the winners in this game from those that keel over and give up. Use this book as a reference and ask yourself before you enter any trade, does it belong in the book? Number 6, structure. Create a rulebook and process. This goes alongside number 5, and you don't need to leave any time in between these stages. This is simply a written rulebook to accompany your A-star book, giving you a more rigid structure to follow. This could be guidelines such as don't trade on macro event days, only risk maximum 2% of your account per trade, or never let anyone else's opinions affect your decision-making process. They are simply guidelines that will keep you in place and steer you in the right direction. This will naturally be an evolving rulebook as you progress, but having this structure will give you a good framework in which to operate and save you from making costly mistakes. Next, put together a process template. This is a table or form that you fill in before you take your trades. It will ask you questions about your trade, such as, is this trade pro-trend? Does this trade truly belong in the A-star book? Or is your stop placed responsibly at invalidation? Before you take each trade, fill in this form as honestly as possible and only enter if you're given the green light, so to speak. This will stop you from entering many a losing trade and ensure you stay focused on the winners. I wouldn't recommend this as much for scalpers, however, as they likely won't have the time to do so. Number 7, apply capital. I'm sure you're thinking, finally, the time is here. But unfortunately, you're going to be met with the boring answer, which is to apply very little at the start. And by very little, I mean an amount you wouldn't think twice over if you lost it. A good benchmark I often refer to is what you would spend on a cinema ticket. This is simply to start getting a feel for application and putting real skin in the game, executing actual market or limit orders, experiencing getting stopped on positions, and hitting take profit levels. As always, it's critical throughout this process to journal in a written format, documenting where you went right, wrong, and your emotional state throughout the trade, amongst many other things. But also use a stats tracker to see your wins, losses, and equity curve, either on the exchange you're trading or via a third-party application that pulls the data automatically via API. If you don't know where to find these, I can leave some options in the description below. Once and only once you start seeing your equity curve start climbing upwards, only then can you start increasing capital. But just make sure to do so slowly. And these are not words I say lightly. Remember when I said discipline is a key tenet of trading? Well, this is certainly one of those times to practice it, no matter how long it takes. This is the hardest part of the journey, and many don't wait for their stats to tell them when to start putting real money down. But if you're thinking about doing so out of impatience, ask yourself, why would you? The stats never lie, and if your equity curve is still sloping down, save yourself the stress and financial loss. Be patient. On to number 8, Kaizen. Kaizen is a Japanese word that means continuous improvement through small but consistent positive changes. I've always considered myself an eternal student and believe this is the mindset you should all take in this craft. Not a student to any mentor per se, but a student to the markets. Through journaling, reflection, and integration, we continue to sharpen our edge and outperform our past self. Make no mistake, this is still a competitive game, but now the competition is against yourself. Now, this is all well and good, but I'm sure you're asking yourself, how do I actually learn how to trade the markets? Well, I've got an all-in-one solution for you, distilling my many years in the markets into a trading crash course that will take you from novice to pro quicker than anywhere else. So, what are you waiting for? Click here and start your journey to profitability.